accounting lesson. Today I'm going to continue with my previous lesson on ratio analysis. I had covered about 2 classifications, so I was remaining with about another 2 classifications. I was finishing up the activity ratios and then I go into the profitability ratio because I talked about the leverage ratio and also talked about the current ratios. And then now we're looking at the activity ratios where I had talked about the debtors and creditors ratio and then the stock ratios. So today I was to look at actually the working capital ratio or asset turnover ratio, which under this one we also have the working capital turnover and then the fixed asset turnover, which still considers actually the activity ratio. So we have under the activity ratio we have the asset turnover. The asset turnover. So under the asset turnover, that should be actually number 5. Under asset turnover, we find that we are talking of where we considering the return or the return basing on now the assets that we have, the net asset in respect to the sales that we generate. So here we are comparing the sales to the assets. That's net assets. So when we're looking at the net assets, how are they helping us to generate the amount of sales that we have? And that's what we call as asset turnover. How is the sales helping us, or the assets helping us to convert stocks into sales? And that's what we call as the asset turnover. Now this ratio is actually expressed as sales over the net assets. Over the net assets. Now the net asset is also referred to as the capital employed. It's also referred to as the capital employed. So meaning when you take all the total assets minus the liabilities, then whatever you get is what we call as the capital employed or the net assets. So that's what we have there. Now if you have in a year you have sold sales coming to maybe 400,000, and then our net assets are 2 million. Then we're calculating the asset turnover to be 400,000 over 2 million. Over 2 million, and this actually is the relationship between of now the return, or now how you're helping this to generate. And most of this one is actually expressed in percentage form. So we shall have those 3 going, those 2 going. Then we have this one with that 40 over 2, which will actually be 20%. So meaning now our assets actually are generating 20% of the sales. Our assets are generating 20% of the sales. But then if we could express it in a decimal, where we shall see now 4 over 20, which will be 1:2. 1:2. So to the calculations on the sum. Is to 0.2. So meaning now every asset is generating 0.2 of the sales. That's what you have as actually the asset turnover ratio. The asset turnover ratio there. Now I said that what I've stressed here is actually talking of the net asset, not the gross assets. Meaning you don't just take the assets and then relate it to the sales. No, you take the total sales and then relate it to the assets which are minus the liability there. The other ratio which falls under the activity is what we call now the working capital turnover. Working capital turnover. Working capital turnover. working capital turnover. Now the working capital turnover is we are relating the sales to the working capital. Remember, the working capital is the relationship between the assets, current assets and the current liabilities. So we shall be saying here now sales, our ratio being actually sales over the working capital. Over the working capital. So I was saying now we are relating our working capital, where our working capital here is expressed as current assets minus current liabilities will give us the working capital. So we shall be taking the current asset that we have, then minus the current liability, and that will give us actually our working capital. Meaning now, from the capital that we have, or the total current asset that we have, what actually we minus the current liability that we have, then that difference will help us to see what our capital, part of our capital that's actually injected in generating. So if, for example, we had now sales being 400,000, and then our current assets, that's now sales, while our current working capital or current assets, and then current liabilities. So our current maybe is 40,000, 140,000, while our liabilities are maybe 80,000. Then we shall be seeing 400,000 over 80,000 minus 140,000. So that will be 400,000 over 60,000. So our working capital will actually be expressed based on those two there. So we shall see actually that this our sales 400, while our working capital is this much here. So we shall have this going with that one. So the one is to what? 40 divided by that. 6. It's to 6.7. So I could given to 6.7 there. So for every asset actually generating an amount of 6.7 of the sales, 6.7 of the sales, which you can actually multiply by 100. Is 6.7 multiplied by 100 will give us actually the 60% or 67% as the return on capital. But now this is the turnover. So we're expressing it in respect to the relationship between the sales and the working capital. The sales and the working capital. So that is it, and then we have the fixed asset turnover. The fixed asset turnover, which is another one, which should be the last one under this activity ratios. Fixed asset turnover. And the last one. And this one, of course, is just relating. Whenever we talk of turnover, then you're talking of sales. That's what you should know actually in my lectures all the time. When we talk of turnover, then you're talking of the sales. But you talk of return as the income. That whatever has been generated, profit or the income has been generated. So here you're relating to the sales that you're generating to the amount of the fixed assets that you have. Now here we're just talking of the fixed asset irrespective of whether they are net or not, so gross. So we should just be taking our non-current assets and relating them to the sales there. So gross non-current assets. Then relating them to the sales. Relating them to the sales there. That's what talk of us now, the fixed asset turnover. So our formula will be the fixed asset turnover will just be equivalent to sales over a non-current asset. Non-current asset. So if we had our sales being 400,000, while our fixed asset will be 4 million, then our formula here, or our portion here, will be taking those 3 and then this 2, and then that will be that is 4, and this 1 is to 4 divided by 40. It will be if you want to put something.
0.1.
0.4. So each asset is generating a sale value of 0.4. For every asset, this amount of actually 0.4 of the sales. So 1 shilling of an asset brings us a sales of 0.4 shillings there. That's what actually it means there. So meaning, if you had an asset, 2 assets there, or 2 assets which are worth 100, that's what actually our ratio means there. But if you add assets of 100 assets there, then they'll generate for you 0.4 of the sales. So this times that, it will give us how much? 4. 40, yeah? Yeah. But there's only 1 point. So this will actually be the sales. So with 100 shillings of an asset, then you generate sales of what? 40. So that's actually what that ratio there means there. So that's why I always like simplifying that for everyone. See also here, 1 is to 6.7. So meaning if you have actually a working capital of 1 shilling, then it will generate for you 6.7 of the sales. If you have 100 of these, then that will be 667 or 670 of actually of the sales there being generated out of the same. So here meaning the sales are more than actually the working capital that we have in that case. So I'll be talking of more explanation of rating ratios there. The simplest thing will be that whenever we talk of the fixed asset turnover, meaning sales over the fixed asset. When you talk of actually working capital, then it will be sales over the working capital. Where working capital is the current asset minus current liabilities. When you talk of the asset turnover, you're talking of the net assets. Then it will be sales over the net assets. Here is actually the gross asset, but here the net asset, meaning the total assets minus the current liabilities, or the liabilities will give you the net assets there. That's how we work in that case there. So that's our activity ratios that I wanted to finish up with, and that. And of course, I've stressed there that our net working capital will always be the difference between the current asset and the current liabilities. So that's it for our activity ratios. That's it for our activity ratios. So viewers, I want to go now to another one, the profitability ratio, which I know most of you have been waiting so much for, the profitability ratios. Profitability ratios. And these are very common. Profitability ratios. The profitability ratios. Now, the profitability ratios always relate to, I should be number 4. The profitability ratio is the one which assesses the ability of a firm or a business or a company to generate higher profits at any situation. So it helps us to be able to assess the level of a company in profit terms. Simply that's what it means. That these ratios always help us to assess a company or a firm in respect to the profitability in profit terms. We'll be talking of the sales here. How we're utilizing our assets to generate sales. Because sales, the higher sales, the higher the profits. But now, if we have such a number of assets, are we generating high income from the sale? I've interpreted all these ones from whatever we've been seeing here. And now here we're talking of now how profitable is our business. Now there are times when a business the economy may be performing poorly. Then how able is our firm to survive in this kind of economy? So our profitability will tell us that. So when they also have some constraints, like maybe there's a limited supply of material which are using for selling or for manufacturing, then how profitability or how shall we be able to survive in our market? The profitability ratio will actually tell us that. Maybe there's a limited demand in the market for a product that we're dealing with, then how is the firm going to survive? Profitability ratio will actually explain to us if that company is able to survive or not. So it will be assessing now the profit in respect to the cost that you incur. You should be getting the profit in respect to the items that you are actually making assess. That are limited supply or ability supply of raw materials or the goods which you are meant to sell, how shall we perform as a company? They need to be determined by the profitability ratios there, which I'm going to mention there. And here we have about 1, 2, 3, 4, 4 of them. So the first one is the gross profit ratio or the gross margin ratio. The gross profit or gross margin ratio. Gross profit, number 1. Gross profit or gross margin ratio. Gross profit or the gross margin ratio. Now, when talking of the gross profit or margin ratio, then we are saying that we are assessing how the company is able to generate a gross profit. Now, gross profit, of course, for us who've done accounting, you know what that means. The gross profit is normally the difference between the sales and the cost of sales. The difference between the sales and the cost of sales, so to call the gross profit. Meaning, when you take our sales to be 1,000 and our cost were maybe 200, then our gross profit here will be 800. That's the gross profit that we're talking of there, which of course is the same as the gross margin. Now, the essence of the margin will be relating mostly when you are doing the production, like in factories, when you are generating the incomes or the items ourselves. We manufacture item, we go and sell, and you talk of the gross margin. That means the difference between the sales and the direct costs that you incur to give us the gross margin there. So we're talking about the direct cost there much later in our study. So when you take the sales minus the cost of sales, it gives us the gross profit. So this is the one now we are assessing. What is our ability? Our costs are 200 while our sales are this much. Then our profit is extremely high, 800. So which percentage is this? For every cost, how much are we actually receiving as the profit? So relating the cost here to the profit. That's what talk about now the gross profit margin. So we shall be relating the gross profit to the sales that we're making within a certain period. And mostly this one are expressed in percentage form. Mostly expressed in percentage form. Expressed in percentage. These others will be relating the two. Alternatively, putting the percentage there, but mostly expressed in decimal. But here, we'll be expressing most of our ratios in a percentage form. I'll be explaining that. So, our formula in this case will always be the gross profit over the sales times 100. That will be our formula and give us actually the gross profit margin ratio. The gross profit margin ratio. So the gross profit margin ratio is actually the gross profit over the sales times 100. And as I was saying now, we are relating the gross profit that we're generating here to the amount of sales actually which has been made. So meaning now, we are assessing the ability of the firm to generate a profit given the amount of sales. Like if you make a sale of 100, then how much of the profit shall we generate? That's why the percentage is coming there. Because relating to a percentage, meaning a fraction of 100. A fraction of 100, so the covers a percentage there. So if now, like in our case, we had the gross profit being 800 from our example, then we shall have our gross profit being 800 over the sales, which is 1,000, times actually 100. Times 100 there. So in this case here, we find that our, we do this one, then we shall have what? 80% as actually our gross profit margin there. Gross profit margin will be, margin ratio will be 80%, which is very high. Meaning, for a single sale, with 100 of the sales, actually you make a profit of 80. That's what it means. You make a sale of 100, then you make a profit of 80 shillings there. With a sale of 100, you make a profit of 80 shillings. That's what we mean by 80%. Meaning, out of the 1,000 of the sales we made, actually we made 800 as the profit, which is actually the same. Meaning, if you make a sale of 10, then 80 will be the profit. Not 8 will be a profit, not 80. 8 will be a profit. That's what a percentage actually simply means there. And I want to actually merely make it simple like that. Now, that one we're expressing the gross profit as a percentage of the sales. Maybe I can just write it there. Gross profit as a percentage of the sales. Gross profit as a percentage of the sales. And that's what we call as the gross profit margin ratio. The gross profit margin ratio. But under the same, we can still also have what we call as now the gross profit as a percentage of the cost of sales. And that's what we call now as the gross profit markup. I want to have that one as the second one. As my second one, the gross profit gross profit ratio. The gross profit markup ratio. So this one here now is still the margin, but now in this case it's relating to the cost. The gross profit markup ratio relating to the cost. I've explained here under the margin that given maybe a limited supply of the sales, how will be our profit? That's why we are relating the sales to the profit that was generated. So we say the gross profit margin ratio, meaning we are relating the gross profit to the sales. I've given here the gross profit as a percentage of the sales. Talk of it as the gross profit margin. But now when we come to the gross profit markup ratio, then we are relating the gross profit to the cost. So here we say it's actually the gross profit, and we are writing it down there. But here we are saying we are actually relating the gross profit to the cost of sales. Cost of sales. Cost of sales or goods produced. Or the goods produced. What we now as the gross profit markup ratio. So meaning now, the cost that will be incurred to produce these items there, how are they relating to the profit you're generating? Now, what I'm saying this is because we may have a limited sale market. How will be our profit? We may have our price of the cost of the items being produced being high. How will it affect our profit? Or this limited supply of the goods which are meant for sale, then how will be our profit? The price may be actually be limited in the market of the sales, then how will be the profit? Here the cost of the items may be restricted or rise abruptly. How will be our profit? So that's why actually we're having this ratio being computed here. Now here, simply what we always do here is actually we take the gross profit as a percentage of the cost of sales. The gross profit as a percentage of the cost of sales. So our markup ratio, GP markup ratio. Is always the gross profit, right, in short, over cost of sales. Over the cost of sales. So we take the cost of sales, gross profit times or cost times 100. I say this one, let's express them in percentage. So we take the gross profit over the cost of sales times 100 to give you now the markup ratio. Simply we let me define them like so. This is the margin ratio, or the margin ratio, and this one is actually the markup ratio. So margin is expressed on the sales, markup is expressed on the cost. So For example, now we had maybe, in our case here, we had the cost. Because we know the cost of sales here at 200, while the sales were this much, we got a profit of that much. So we shall be saying here, markup ratio being equivalent to gross profit, which was how much? 800 over the cost of sales, which is 200 times 100. That will give us actually our ratio. So we shall have, of course, this one going that will be what? 40%. So our markup will actually be 40%. So you can see you're expressing it as a percentage of, let me just write it here. Gross profit as a percentage of cost of sales. As a percentage of cost of sales. That's what it means actually with the markup percentage. So you can only see, like now I've used the same example here to calculate the margin. I've used and also use it the same to calculate the markup. And now our percentages here are not the same, but our profit are the same. I'm going to that one later. That our profit here is 800, our profit here is still 800. But the percentages that we're getting here is 80%, the other one is 40%. But both of them will give us the same profit there with the same sales and the same cost. So, meaning one of them is actually, we are starting from below, while the other is starting from above. Like the margin, we are starting from the sale part, which is higher figure, while this one here, we are starting from below, which is actually the lower figure there. So, we have 40%, I'm doubting that, 1,000, 200, so those are two zeros. 40%, okay. And then this one here, those two zeros.
There, 400. 400.
This one is this way, this one goes back.
And the other one? Yes.
It's okay.
400 down there.
Down two zeros.
400 there. 400.
Okay. This one is 2,000. 200, which is okay. This 2 goes with that. This one was 800.
So
okay.
it should be 4.
Still okay. No problem there. So that's actually what you have there. That one of them you're coming from below, one of them actually you're starting from above there. So that is essentially what we have there. Profit there, profit there. This sales, which was 1,000. So that's it. So I'll be coming back to how actually the relationship between the two. That will be my next lesson. I'll be relating between the markup and the margin in my next lesson. I'll be explaining why the two are seeming different, while actually relating to the same profit there. Now, that is so far for the gross. I'm going on to the net now. Because we have been talking of the gross. Now I'm going there now to look at the net profit margin and the net the net profit margin. So that should be number. This one was number 2, yes. This one was number 2. So we have number 3 here. The net profit margin. Net profit margin. Now, when we are talking of the net profit margin, we are considering now our profit, gross profit minus the expenses, because the net profit is always gotten by taking the gross profit minus the expenses. When you take the gross profit minus the operating expenses, then that gives you the net profit. Gross profit minus expenses give us the net profit. So that net profit is the one we are targeting now. As I was saying now, let me explain this one also. That we are relating our net profit to the sales that we have actually generated there. The sales to the profit that actually we have generated. The net profit to the sales that we generated. So we want to see now a relation between our sales and the net profit. Our sales and the net profit that we are generating over this period. So when we're talking of now the net profit or the net profit margin or the net margin, then we shall be expressing our net profit as a percentage actually of the sales figure that we had, a net profit to the sales figure that we have. So we have here our sales. Maybe let's assume our expenses came maybe to 400 or 1400, meaning 1,400. That's too much. We put it as 600. So our net profit expenses actually are coming to 600, but the sales and these other things remaining the same. So we shall be getting the gross profit minus the expenses being equivalent to net profit. So here we shall say our gross profit was how much? Our gross profit was 800 something. 800 minus 600. So our net profit will be 200. Our net profit will be 200 there. So we want to express now our net profit as a percentage of the sales there. So as I was saying, our formula in this case, our formula will always be the net sales that we calculate our expenses, the net profit that we're generating as a percentage of our sales for the period, where we're comparing our profit to the sales for the period. So our net profit here is 200, or net profit over the sales times 100. That gives us our formula of the net profit margin. So our net profit is 200. Our sales were how much? Our sales were 1,000 times 100. And gives us a certain percentage there. 20%. So our net profit margin will be 20%. So mostly we always say we express it, the earning before tax, earning before interest and tax over the sales. That's actually our net profit margin ratio. Our net profit margin ratio. Whenever you see that one as a formula, it's still the same thing. Then the earning before interest and tax is actually the net profit, meaning before we minus interest and taxes. If it's a company, we always minus interest as an expense. After preparing our net profit, we minus the interest and then we minus the taxes. That's now earning after. Whatever is to be distributed is always the earning after interest and taxes. But this one is earning before interest and tax, meaning before we minus these two is the profit we take. Then we express it to the same. Because those interest and taxes are actually not associated with the earnings of the company. So we need to calculate it before we come to that. So we are expressing this one, of course, times 100. That will give us that one there. So meaning, for every sale that we make, we shall actually be generating a profit of what? 20%. 20%. Meaning, if we generate 100 of the sales, then 2. Or 20, if we generate sales of 100, then we shall have 20 as the net profit from the same. That actually makes it easy for accounting, for people to understand the interpretation of the account. Because the interpretation analysis and the interpretation of the accounts there. That if we make a sale of 100, then out of it we shall generate a net profit of 20. But a gross profit of, say, of 20%. A gross profit of 20% is what we shall be generating. Then from that, we generate 20% of the net profit because of the expenses there. And I've talked about the earning before tax being an interest being the net profit margin there. Now the next one we have there is the return on investment. The return on investment still under profitability. Return on investment. Minister of this covers. So return on investment, that should be number 4. Return on investment. Return on investment. Now, as I was saying, these are things which are meant to help us to understand how our firm is performing. To understand how our firm or a company is performing. So return on investment. Here we are considering not what is our investment in the firm, what is our investment in the company. Investments here are what you know as what? Investment is actually in form of assets there, which are typically normally capital employed. We take the total asset minus the liability to give us actual to cover the capital employed. So these are our investments. These are our investments in the business. When we introduced capital in the business, that capital went ahead and what? Bought the assets. So what we have in our business is those investments there. Now, what is the return on whatever we have actually invested in that business there? So the same way, when you say this is our investment, meaning now we take all the value of the asset or of the business, the total value of the business minus the liability to give us our investment. Simply that's what it means. The total value of the business. If the business is worth 10 million and you have debts of 2 million, then your investment in that business is 8 million. So I was saying here, my capital is 10 million, while liabilities, whatever belongs to the outsiders, is actually 2 million. Then our investment in the business is actually 8 million there. So that's what we are saying now. How is this 8 million, which is our investment, generating? How is it generating? And that's where now we consider actually the profit that is being generated and compare it with the investment. Remember I talked about under the activity ratios, I said we compare our assets to the sales that they're generating for us. That was turnover. But now we are taking off the returns. So the investment, return on investment. As I said, whenever you see anything returns, anyone returns, then that is the profit for income. That's the income there. Returns relate to income or profits, by turnover relates to sales. So we want to see now, we've generated so much of the sale because of the assets that we have. Now how much of that is actually remaining as our profit and for our investment there. So under the return on investment, then you should be considering the earning before tax, interest and tax. That's the net profit over the capital employed or our investment there. So the formula here is, the formula here will be the net profit or earning before interest and tax over the capital employed. Capital employed, what we're talking of now is the net assets there. Net assets. So that's our formula. That we look at how much the profit, the much of the profit that has been generated, and then relate it or compare it to the assets that have been generated. What you so simply also refer to as the capital employed. And of course, I remember as I said, under this we're talking of actually reaching to 100. The return. When talking about return, we express it in percentage. When you're talking of the turnover, then we express it in ratios, plus other ratios, actually decimals there. So here, for example, if we had our net profit, of course we know it. And then we have assets. We had capital employed. Capital employed, I think I had it somewhere. This is our total assets. I'm looking at actually the capital employed. Net assets, net assets, net assets. That's 2 million. So we have 2 million. So if we have our net profit here have a net profit of, let's say, 1,200,000, and our net assets, that's capital employed, being 2 million. Yeah, 2 million. Then that what will be our actually return on investment. So return on investment would be the net profit, which is the earning before interest and tax of 1,200,000 over 2 million times 100. Times 100. So now those zeros going, those 3 going, and then you have 1 here. This will be 60. So 60% return on investment. That will be your return on investment. Meaning, for every 100 of the assets, we shall generate a profit of what? 60. Every 100 of the assets, which generate for us a profit of 60. But we see now the return, meaning which percentage of the asset or the profit is actually being generated from the sale of the asset that you have. So for every 100 of the assets, they are generating for us 60% of the profit there. So meaning 40% of the assets actually are not generating. 40% of them are not generating. It's only actually the 60% of them which are actually generating income there. So we need to assess ourselves and see now if they're giving us a return of 60%, is it profitable, is it not profitable? But of course 60% should be good because it's more than 50%. Anything above 30, 40% actually will be ideal for a company to generate income. Lastly, under the same, I have the return on equity. The return on equity. Return on equity. Return on equity. So just read it here. Still talking of return, which still is also talking of return meaning net profit. So we're relating the profit to the net worth, equity. So here we're relating the return, profit before tax and interest, and relating to the equity. To talk about the net worth. Net worth there. So we shall be taking the profit before interest and tax over the net worth. Over the net worth. So for example, if you had up to our profit still remaining with 1.2 million, what's times 100 over now our net worth. Now our net worth or equity is where now you take the capital plus any other earnings that the company has actually invested over time. So let's say now maybe it's 3 million there, or 2.8 million. $2.8 million being our equity or net worth. Then we're calculating this. Let's take 0 go. And then have 1,200 divided by that much there. So we're calculating the return on equity or net worth. Return on equity or net worth. So it's actually 1,200.
Yeah.
Divided by 8. So that will be 43%. That gives us actually 43% there. So that's actually our return on equity. Return on equity in our ratio there. So that is what talk about now the profitability ratios. Profitability ratios, what you have there, profitability ratios. Now, I think I've talked about all the ratios that we have. I've covered everything on ratios. I talked about the liquidity ratio, I talked about the capital structure or leverage ratio, I talked about the activity ratios, and then I finished up with the profitability ratios. profitability ratios. Now what I need here to look at is now some computation relating to the same, questions relating actually to the same. And I've talked about the interpretation of each of those. I'll be going deeper when I do questions on the same. When I do questions on the same, then we can look at that. So I don't seem to have a space here. Now. So you can be looking at those formulas. So I need to give an extra sum. Single question which may help us be able to look at some of those real computational ratios. And as for those who are doing the exams, I think you should be able to grasp those formulas with a lot of ease. There's nothing much there. You don't need to gram. Those formulas are so easy to understand. I always believe that formulas, you merely understand them and you memorize and not gram in them. Because if you gram, when you get to the exam, they disappear and you will not have anything to do. You start fumbling, trying to copy. So what you merely do is actually memorize and understand those formulas there. Like for example, I've talked about the fixed asset turnover. We're only talking of the turnover being sales, relating them to the fixed assets. And when relating now the assets to the sales, because it's the assets which are relating the sales, so the sales has to be on the top. And what is influencing it is on the bottom. The same way here, profitability ratio. We say the gross profit margin. That here we are saying how actually is the sales generating the profit. So the sales determining the gross profit. So the sales will be below and then the gross profit on the top. Here also we are saying now the cost determining the profit. So the profit will be on top of the one which is determining it. The same case here for the net profit margin. We said actually the sales determining that. Come to all the others, even the profitability, the net profit earnings, shareholder those transfer. Actually, the formulas are easy to understand and you don't need to cram anything there. Now, I want to look at now a question. Well, maybe we can look at some of the questions or the computation, how to compute those ratios there. So I have a question here which is relating to a balance sheet of Y Limited. A balance sheet of Y Limited. Balance sheet of Y Limited, which shows the following assets and liability. And liabilities as at 31st March 2002, 2003 there. So we have assets and liabilities here, and they are starting with the assets. We have a cash at bank. The cash at bank here is actually 50,000. Then the next one is actually sundry debtors, and sundry debtors here actually are 10,000. We also have inventories of 5,000. We have 45,000. Inventories of actually, this was 100,000, this one 50,000. This one is 100,000. This one is 50,000. And then we have securities of 200,000. Those are marketables. Marketable security of 200,000. Then we have prepaid expenses. Prepaid expenses of 10,000. Then you have a total of those giving us 1760,000. That should be 1,760,000. That's 800. This is 100,000. It's 10,000. That can't be. Oh. So it's a million. Then now we have sundry creditors. Sundry creditors given us 400,000. Then we have income tax payable of 200,000. Tax payable of 200,000. Bills payable. Bills payable of 100,000. And then you have lastly outstanding liabilities. Outstanding liabilities, which is given as 30,000. And that one gives us a total of 730,000. 730,000. So they are saying from the above, actually, they want us to calculate the ratios that are applicable to the same. From the above, we calculate the ratios which are applicable to this. So these are assets and the liabilities which you have here. So of course the cash at bank is the current liability, sundry debts is the current liability, securities actually are fixed or current assets. I'm sorry, all these are current assets, this was a current a non-current asset, and then also this one here is a non-current asset there. So this is giving us actually that total there, of which is actually correct, because this one plus that that figure there. Still doubting those figures. My question here. That's 1 million, that's 500,000, 200,000, yes. This one is 500,000 and not 50. This is 500,000, yeah, so that gives us that. So inventory 500, security 200,000 and all that. So we want to calculate ratios that relate to this. Ratios that relate to this. And maybe we can calculate, of course, we can start with what we call as the liquidity ratios. Liquidity ratios. So let's start with the liquidity ratios under this. So number one is the liquidity ratios, which we looked at there. So under liquidity ratios, of course, we talk about the current ratios. Current ratio, and we say that under the current ratio, we just say current assets over, over the current liabilities. Over the current liabilities. So we're letting the two, we express it in decimal because we are seeing now the relationship between the two of the assets that you have, how many liabilities are there. So from this, you have to look at the current assets. And remember I said the current asset here I talked about the cash, I talked about the debtors, inventory, and repayments. Those ones are actually adding up to give us now the current assets that we have in that question there. So I'm taking this one to be fixed assets here. The securities, marketable securities, I'm taking them to be non-current assets. So when you take this one now, that 1760 minus now 200, that should give us 1560. So our current assets here will be 1560,000. 1560,000 over our current liabilities. And I'm seeing all these to be actually current liabilities, so it will be 730,000. So when we're calculating these ratios here, and let's look at actually what that gives us from computation. It will be 1560,000 divided by 730,000. So that gives us 2.13. So for every asset, there are 2.13 of for every liability, there are 2.13 liabilities there, or assets there. So every liability, there are 2.13 assets there. So this one will be representing the liability, and then this one will be representing actually the current asset. So meaning every liability that you require to pay, we actually have 2 point something of the assets. So we are sure, and this one is an ideal ratio, meaning you can go to pay this liability and remain with 1.13 of the assets to run the business. So that's what talk about now, the current ratio. Now I have also looked at the liquidity, the liquid ratio or the quick ratio. The quick ratio, our asset test ratio, acid test or quick ratio. Acid test ratio or the quick ratio is what we talk of now. We take the current assets minus inventory over the current liabilities. So those assets current assets which can easily be converted into cash are the ones we talk of as the quick ratios or the acid test ratio. We take the inventory cannot be converted into cash so fast. You may sell inventory but you get debtors, so we may not get the cash. So we minus it from that, then we get now the difference being now the quick ratio. So in our case here, we are taking the current assets to be 1560,000 and minus the inventory, which is actually 500,000. So it will be equal to 1560,000 minus 500,000. None of this we divided by now the no-show liability of 760,000 there. So this will give us 1060 here.
Yeah.
1060,000. That's enough. 1060 over 730,000. So our asset test ratio will have to be now dividing the two. If you have as 10. 60,000 divided by 730,000, which will be 1 actually 1.5. So it will be 1:1.5. That's our ratio. So meaning our quick ratio will be every liability there 1.5 of the assets. So this one is actually more than the ideal. It's actually meaning now we have so much of our cash actually lying fallow, we're not utilizing the 0.5 of it. Because the ideal ratio here, I say the ideal ratio is always 1:1. But whenever it goes beyond that, then we are actually holding so much of the cash in our hands, which is risky also, and also it's actually lying fallow. So it's supposed to be an ideal ratio of 1:1. So that's our quick ratio formula there. That's our quick ratio formula in that case there. So it will be 1.5, that being our ratio in that case there for our question that we have. Now we're going on to look at now the other one which you talk of actually the cash ratio, which I didn't mention in the other case, but I can also talk about it here, the cash ratio. Cash ratio. Now here we're relating to purely cash. We talk of now the current cash at bank, cash at hand, plus bank balance over current liabilities. Let's talk about now the cash ratio, meaning you are assessing the ability that even that liability, any creditor comes and wants his money, without having to look for anything else or payments or anything, can he be able to pay his liability? Let's look about the asset cash ratio. So we take like our money which you had here, cash on hand and bank, that had been combined. So it's 50,000.
Yes.
So it's 50,000 over still the amount of 730,000. Is it 50,000 really?
Yeah.
Yeah. Over 730,000. So let's 30 go. This one is. So for A level liability, and to see how much of the assets will be actually there. Every liability, how many of the assets will be there. So that's the 50. So 5 over 73. Think so?
Yes.
So that will be 0.06. 0.07. So meaning now we cannot, even in case the creditors come to us, we cannot pay the whole amount of the liabilities that we have in that case. Because for every liability there are 0.07 of the cash available in hand and in bank. So that's not an ideal ratio. It's actually the company struggling, and it can struggle whenever they want to pay the liabilities there. So that's what you have as the asset ratios there. So in our question, we will not be able to calculate all the other liabilities, or other, not that, but other ratios that you have. Is what we are going to calculate in that case there. Now, I also want to look at a question which has now, which you can be able to calculate other things apart from merely the liquidity ratios. The liquidity ratios. Now, in this case, I have a question here, which I'm also going to prepare. A setup. A question which will involve us to calculate the activity ratios and even the profitability ratios. Activity ratios and the profitability ratios. So, I'm going to look at case in hand. And as I was saying, the formulas should be easy. The computation is based on merely how you understand the items in an asset, in a balance sheet. And then also the interpretation based on now what you know about those items that you have. You're relating to like profitability, we're talking of the profits, how the company is able to generate profit. When you're talking of the activity, then you're relating on how the resources that you have are actually contributing towards the profitability of the company. We talk of now the liquidity, meaning the liquidity is cash. How the firm is able to meet its obligation whenever they fall due. So it's nothing to gram here. You merely require to understand the terms as they are used in accounting. They are used in accounting. already have explained in detail here. So let me try to set up again. We can do one more question which has all the ratios. Should be able to do it. We could to go proceed to another level. Now there are a question here which is relating to the balance sheet of X Limited again. The balance sheet of X Limited as at 31st April 2003. So here we have the assets on one side and the liabilities on the other side. So we have share capital here, we have supplied it here. Have the share capital, and the share capital here is 300,000. Then you have reserve and surpluses. Reserves and provisions. Amount is actually 280,000. Then you have 10% debentures. 10% debenture loans, which are actually 100,000. 100,000 there. And then we have 12% other long-term debts. Long-term loans. Other long-term loans, which have 12% earnings, 200,000. Then we have 10% short-term, 11% short-term loans. Short-term loans of an amount of 300,000. 300,000. And then lastly, we also have trade creditors, 95,000. Talk about trade payables. Trade payables of 95,000. Lastly, you have provisions. Provisions of 205,000. That's for one side, for the capital or the liability side. Then you have fixed assets. That's the non-current assets of 500,000. Then you have other non-current assets, 200,000. Other non-current assets, 200,000. Now we also have the current assets. So under the current assets here, under the current assets we have inventory. Some are raw materials. Raw materials, which are given as 200,000. Maybe finished goods. Finished goods here we're given as 200,000. Then stock in trade. Talking of stock in trade, Stock in progress. Stock in progress, that's work in progress, is actually 100,000. 100,000 there. Then you have debtors of 200,000. These are receivables. 100,000. Lastly, you have cash bank. Cash and bank given us 80,000. So our totals on either side are coming to 48,000. Being our totals in that case. So we are required actually to calculate the liquidity and capital structure ratios there. That's the question there. You calculate the liquidity and capital structure ratio. But now in this case, we can as well even, but we don't have the profitability because we didn't have any profitability there. So what I want to do here is, first of all, I start with looking at the liquidity ratios. Liquidity ratios. Liquidity ratio. So under the liquidity ratio, I remember I've done in the other case, we have the current ratio and then the quick ratios. So the current ratio which we said the formula here is the current assets over current liabilities. That's the simplest ratio that we have here. So in our case, we want to calculate now how much is the current assets and then how much the current liabilities. So our current assets here, of course, we have all these. All these are actually the current assets there. So we shall be taking the sum of all those. We sum all that. We are summing all this. Or alternatively, we take the total minus, because this is 200,000, that's 500,000. So 1480,000 minus it's 700,000. So that gives us 780,000. That's the 700,000. So our current assets are 780,000. Now our current liabilities is what you're looking at here. So our current liabilities, we are taking these are long term. So the current ones are the short term of 900, the 95, and the 205, or not 205. It's actually 95,000 plus 300. Yeah, that's the trade payables of 95, and then the short-term loan of 300,000. So that gives us 395,000. 395,000. That's our current liability. So to calculate our current ratio, it will be 780,000 over 375,000. So our asset ratio here will be, our current ratio here will be 750,000 dividing it by 375,000. So that gives us actually 2. So for every liability, there are actually 2 assets. For every liability, there are 2 assets there. That's actually what we are relating there. Meaning the lower one is the liability, the upper one is the assets. So for every one liability, there are 2, because this is twice. Actually, that is double that amount there. That's actually an ideal ratio. This one, ideal ratio. Because we should be, when you pay our liability, we remain with 1 to run the business. Now looking at the quick ratio. Looking at the quick ratio, which I remember I said this one, the formula is the current asset minus inventory or stock over the current liabilities. Over the current liability. That gives us what we call now a quick ratio. Now we're going ahead to look at what are the stocks, what are the inventory here. We minus all these inventory from the assets, the current assets that we have. So our current asset here already we know is actually 750,000. So we are minusing the inventory. So in our case here, the inventory are 200,000 plus 200,000 plus 100,000. So that's 500,000. Yeah?
Yes, 500.
So it's minus now 500,000. Then you're dividing it by our liability, which is how much? 375,000. So that gives us our ratio here. So our current quick ratio here will be, we're dividing that. Where we're taking now 750 minus 375, yes? No, minus 500.
Minus 500.
So that gives us 250,000 over 375,000. So divide by 375. So it gives us 0.1. So for every asset, every liability, the quick assets here are 0.7. 0.7. So meaning we cannot be able to pay all our liability with our quick assets that we have. Why? Because they are less. We are less in the stock which cannot be converted into cash very fast. So we remain with a 250, which actually cannot be able to cover the liability that we have in our case here. So we shall be short. We can only cover a few of our liability when we actually face our cash that we have. You can see it's less than what we are seeing in that case there. So that's what you have as for the quick ratios and the current ratio and that one there. Now, we're also going to calculate now our leverage ratio. And that leverage ratio, we said we calculate the debtors ratio. The debtors ratio. And after the debtors ratio, we said we take the debtors, total debts over the capital employed. Over the capital employed. So that's the common as the debtors ratio. So that was the first one. Under the leverage. Leverage. Under the leverage, yeah. So we shall be taking the total debts that we have over the capital employed, total debts over the capital employed. And these debts that you're taking of here is actually liabilities. The liabilities. Not debtors as such. Total debts. Total debts. Not debtors. Total debts. Total debts. Yeah, total debts. These are liabilities. Those that people are claiming against us relating to the capital employed. So we shall take the total debt or liability over the capital employed. Over the capital employed. The debts ratio. The debts ratio. Actually, liabilities over the total liabilities. So under this, we're looking at now what are the debts that you have in our case here. Which are the debts that we have? Meaning the amount that we owe outsiders. In our case here, the debt of the total, meaning we are considering this one here, and this one, and this one. Those that we owe the outsiders. There's a 10% debenture which belongs to those who have given us the loans. 10%. There's a 12% long term again, and then there's 11% short term. So this is 300 and 300, that comes to 600. So the total debts here are actually 600,000 over our capital employed. Now our capital employed, we say exactly what we take now, the total asset minus the current or minus the liabilities. Minus the liabilities. Now our total value is here. The total of the assets is 1480,000, and then you minus now the liabilities, which in this case are from here to here. So total 375. Because capital employed is what we take now, the total assets, meaning minus the net worth. Total asset minus what actually belongs to, yeah, we have this one here. So that comes to 7 what? 980, 300 plus what? The reserves. Provisions are actually meant for us, so this plus this, that gives us what? 4 plus that comes to 7 minus what? Something which I'm missing here. This was 280. Yeah, so total liabilities in this case. Total liabilities in our case here are this one minus this. So our total liabilities we can say, let me do it from here. Our total liabilities we have, our total liabilities 95 plus 300 plus 200 plus 100. Yeah. These are liabilities, that is 695. So 695 is our total liabilities. So I'm just taking this. The 95 which is trade payables, this one, this one, this one here. All these are actually the total liabilities which are minusing from the total assets to get our capital employed. So our total asset is 1480. So you minus this one, it gives us how much? 5 remained 4, another 5. Then remained 3 minus that 6. 2 minus 6 is 7.
Yeah.
So it comes to 7. 13 minus 6. Is it? Yeah, 75. 75 is our capital employed. So, or not, 75,000 is our capital employed here. So when you're calculating this one here, then they'll give us a certain ratio here. We try to be faster. So it will be 600 divided by 755. So it's 0.7, that's 1. 1 is actually 0.79. Around 1 basically. Around 1. So that's actually the debt ratio. Meaning we are our debt ratio, meaning under the value there. We are comparing now the liabilities that we have here of 755 to the capital employed that we have. The capital employed that we have. So that's what we have there as our debt ratio or the debt ratio. Debt ratio. Now, the other thing that I needed to calculate in this case was what? The second question. Yeah. Now we have the debt equity ratio. The debt equity ratio. Now equity is of course the net worth. The net worth. So here the net worth of course shall be taking this one plus this one here. The reserves plus this will give us actually what belongs now to the business. That will be 580. That's our net worth there, 580. So we shall be comparing. Here they are saying they want us to calculate the debt equity ratio. Debt equity ratio. So here, as I was saying now, we are relating the amount of the debts which are still there. That's now the total liabilities over the net worth. Over the net worth. So Here, our total liability, we've got it as how much? 600,000
Yeah.
over the net worth, which we are saying is what? 580. We've got it as 580,000.
Yes.
So we're getting this one to be 1:2. So that will be 60 over 58.
Yes.
580.
60 over 58.
0.75.
Yeah.
0.75 is to 0.75. That will be the ratio there. For every asset, actually, they are 0.15 of actually the liabilities there. Meaning now, because here remember we're saying we are comparing what we are running the business. How is so much depending on, or the ratio between the debts we've taken out and what we own, what belongs to us. So here you can see for whatever shilling we have, 0.75 is actually from the outsiders, or the ratio between the two. So that actually should be fair enough, because you're having 1 against 0.75, but it was more than 1, then we could find actually our situation not to be good there, over depending on the debts. So here we're over depending on the debts here in that case. Now, we have the capital gearing ratio. Under the capital gearing ratio, we talk about now the fixed interest bearing securities over the equity share capital. Fixed interest security over share capital. That's what we call now as the capital gearing ratio. It's very common. Capital gearing ratio. So when we look at the fixed interest loans actually are these ones here. Those which have a fixed amount of return of interest and they relate them to the share capital. So here we are seeing there are how many? That is 600. Eh?
Yes.
600,000 over our share capital, which is actually 300. 300 there. So those 3 zeros going there, 2 zeros going there. That is what? 2. 1:2. So you can see from our share capital, actually, we are depending so much on what? Loans there. Those are consuming so much of our profit there. It's actually not be very good for us there. And that our own share capital is 1, while the borrowed money is 2. You can see here 300 against 600, which is actually not ideal there. So that is what you have there as the ratios, which capital structure ratios in that case there. So that is it. Now, the only part I've not done, which I'll be doing in my next video, is now example questions on the profitability ratios. Example questions on those profitability ratios if you look at there. These profitability ratios. Example questions, I'll be doing on that in my next video. I started by looking at the activity ratio I didn't finish. And then I've done all that and then given example questions on the side. Thank you so much for today. Pick up.